The focus of the IRS on cryptocurrency increased a lot this year. It is evident enough seeing the question which was on Schedule 1 last year, but now on the first page of the Form 1040. Ahem. At any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? In today's video, we will discuss one of the bubbling and confusing topics out there, which is what is happening between IRS and cryptocurrency. Do you know what is going on between the two and the reason for the high intensity of focus placed by the IRS on the virtual or digital coin world? Everything and more shall be discussed in today's video. This recent focus of IRS and its development has sent chills down the spines of hundreds of crypto users, investors, and traders who are now unsure about their tax liabilities that are pending, in addition to the possibility of penalties, additional interest, and other charges that are linked to their virtual currency transactions in the past, which also may include pending tax liabilities for their past dealings in crypto coins, which may leave them poorer now. IRS is struggling and having a hard time filling jobs and hiring enough staff to help it get through this year's extended season and struggling to overcome its backlog and accumulation of unprocessed tax returns. The countless numbers of taxpayers who have failed in reporting their trading or use of virtual currency in recent years may find themselves to be the target of a new initiative of IRS called Operation Hidden Treasure. According to experts, only their CPA can help. The announcement of the IRS last month was that Operation Hidden Treasure is to find taxpayers that did not report their income from transactions of virtual currency. The Operation Hidden Treasure is a collaboration of the IRS Criminal Investigation and its Fraud Enforcement Office. The CEO of Verity, Kelly Canty, which makes Legible Tax Pro platform, an SOC-audited platform for tax planning and reporting of crypto assets, said, "This initiative includes a dedicated team of criminal investigators trained in virtual currency tracking. Coinbase, the biggest exchange, said they have over 53 million accounts. The size of crypto trading has gone through the roof, and a lot of people are making a lot of money at it. The IRS knows, as a result of its subpoenas to exchanges, that a lot of people are making a lot of money in virtual currency, but they're not seeing anywhere near that number of returns mentioning those gains, which is why they're going after them with a special division." And John Wandrisco, the chief commercial officer of Verity, also said, "We estimate conservatively that 18 to 21 million taxpayers will need to consider cryptocurrency transactions in preparing their 2021 tax returns. As the IRS starts doing more audits, people will turn to their CPA to help them untangle the transactions so they can report them." Since about 7 years after the IRS first addressed the taxation of virtual currency in Notice 2014 to 2021, the level of awareness and the numbers of investors and users in the virtual currency has grown and spread fast. The guidelines of 2014 fundamentally said that cryptocurrencies or virtual currencies are not all currency but properties because they generate income when they are being exchanged or sold. In 2016, a summon of John Doe issued to cryptocurrencies exchange Coinbase acquired and gathered millions of virtual currency users' records. The IRS further analyzed the topic in revenue ruling of 2019 to 2021 as to whether a taxpayer that holds cryptocurrencies, that is, doesn't sell, receives income from a hard fork in the chain behind the virtual currency. A farming operation of cryptocurrency, Christine Mucci and Bloomberg, said that they have talked to some accountants that said none of their clients are involved with the exchange, use, trading, or anything concerned with cryptocurrency. And it was remarked by Canty that he thinks these people honestly believe that, but it is more likely that these accountants' clients are not telling them. He said, "Unlike stocks and bonds, there is no brokerage statement or 1099 for cryptocurrency. So it's up to the taxpayer and the professional to figure everything out based on each transaction. As of now, there are over 5,000 types of virtual currency, and with a single taxpayer in a year engaging in thousands of transactions. With each one of the transactions generating figures to 18 decimal points, this can be prohibitively difficult to analyze and understand. Canty made it known that for the CPAs, the first step is to understand the compliance obligations and that any transaction that involves the exchange of crypto for something of value is a taxable transaction. These transactions include and cover everything from the simple purchase of a cup to the exchanging of a cryptocurrency for another. And he added that the second step is in preparation for the advisory opportunities with crypto, and that Operation Hidden Treasure will only increase the volume of 6173, 3174, 6174A letters and the CP 2000 notices that go out to the taxpayers. While monetary authorities in the real world may find it difficult to regulate cryptocurrencies, it still does not stop the tax authorities from scrutinizing them and tying to tax people and investors who made and are making big gains from crypto coin and virtual coin investments, trading, and dealings. There has always been an underreporting of crypto profits. A credit score service called Credit Karma in 2018 reported that fewer than 100 people reported their gains from their investments in cryptocurrency of over 250,000 Americans that already filed their federal tax returns at that time that year. Therefore, it is likely the IRS is tightening its grip to catch these tax defaulters who are giving a miss in the payment of their taxes on such profits. A certified public accountant and the executive vice president of Virginia accounting firm Piasek, Ryan Losey, told CNBC that there is no free lunch for Americans. If one is richer tomorrow than he was today, then it is likely for the person to have some tax burden associated with that. IRS issued clear instructions in 2014 that the cryptocurrency holdings are not treated as currency that could generate foreign currency gain or loss for U.S. federal tax purposes. Basically, any dealings that an individual makes in tokens, something of value, such as bitcoins, which includes the buying and selling of bitcoins using fiat currencies, or for the payment of a coffee or a laptop, or receiving them in exchange for goods and services, will constitute a taxable transaction. And that is an individual's responsibility to calculate any possible appreciation in the digital or virtual currency valuation between its receiving, that is, buying and spending, which means selling. The IRS advises that for every coin received as a payment for delivering goods and services, the equal fair market value in US dollars should be used in the computation of the gross income of the recipient. However, the use of cryptocurrency holdings for exchange or sale of other property may lead to either a gain or a loss, and stated by the IRS that the character of the gain or loss generally depends on whether the virtual or digital currency is a capital asset in the taxpayer's hands. CNBC further added that if you hold a virtual currency for less than a year, it will be taxed as ordinary income. However, if your holding period is more than a year, it will be taxed as capital gains, which could attract a tax rate anywhere in the range of 0 to 20%. The addition of these tax rates with the other transaction fees and accounting fees for dealing in and using cryptocurrencies, the total of the associated expenses and the taxes may rise to a very high rate, which may leave little to no net profits for some, if not most, of the brave ones that took the courage to invest in the digital currency. If you are one of those who have not transferred or sold your crypto coins, i.e., you are still holding them, then there is no tax liability. The taxation only triggers when there is a transfer or sale of crypto coins that leads to potential net profit or loss. According to the tax offices, mining of cryptocurrency is an activity that can be considered as a special case of self-employment, where an individual receives crypto coins as payment for his mining work, and they are expected to report the fair market value in United States dollars worth of the coins as on the receipt day, when it will be treated as gross income. If also the mining is constituted of both a business or a trade, the miner may be subjected to pay tax for self-employment. Regarding the record keeping, the exchanges and brokers providing cryptocurrency transaction services are at the moment not compulsory to specifically provide tax reports for each person for their trading activities. However, the exchange of coins like Coinbase does provide a cost basis for taxes report, which can be used in the computation of net profit or loss. In the end, the burden lies with each person in maintaining records and calculating and filing their taxes. For instance, if a person cannot show that he bought a Bitcoin for $3,500 in the past, his taxable holdings will be assumed to be full value as per the present day's valuation. The penalty of non-compliance. IRS rules provision for a failure to pay penalty based on the underreporting or no reporting of income from diverse sources for late payment of taxes at 0.5% of the amount of unpaid tax per month in which the tax amount was at when due. Although this is capped at the maximum percentage of 25% of unpaid taxes, it is still a very high figure. Including the earlier talked about penalty, there is also a second penalty stipulated for late filing. This penalty is around 5% of the unpaid taxes for each month starting from the month in which the tax was due. Also, there may be late interest payments due to both penalties. That is, the late payment and late filing. It is advised by the IRS that individuals in general should file even if they can't afford to pay to avoid any possible charges and penalties. Also, know that answering no to the FAW question when the factual answer is yes, based on the FAQ or instructions to the 1040, while technically you are correct, could still lead to unfavorable results. The IRS will argue that you answering no is evidence of intent to conceal the crypto. Therefore, it is advisable to answer yes even if you bought and did not sell crypto unless there is a compelling non-tax reason for you not to. And with the recent activity of the IRS with detail-seeking action on Coinbase customers, the tax collection ball has started to roll, and it might roll towards the other digital and virtual coins soon. You might find out soon that your least favorite uncle is on his way to your doorstep if you have made profits and gains from the big sharp rise in their valuations to collect a stipulated share of these profits in the form of taxes. And that's it for today, guys. We'd like to know your thoughts on the IRS. If you enjoyed today's video, make sure to hit the like and subscribe buttons to follow us for more updates. And don't forget to turn on that notification bell. See ya.